Good evening, everyone. My goodness, standing room only. Lovely to be back here. This is my second appearance at Shares. The first was a year ago. I recognize a number of the faces in the audience. So thank you for signing up to hear from me once again. As mentioned, I'm the CEO of Burford Capital. Burford is a London-listed for both equity and debt, and the world's leading litigation finance firm. And this is actually quite a timely moment for me to be standing here because in addition tonight to talking to you about the business in general and about how the equity has performed, we are actually right now in the middle of a 2-week offering period for our second public bond, second retail bond. There are materials about that outside, both prospectuses and information booklets. It's a 6 1/8% yielding instrument, and the last one of these that we did, which we did in 2014, not only was significantly oversubscribed, raising £90 million, but also proceeded to trade up in the secondary market, delivering an effective yield higher than the coupon. So, in addition to talking generally about the company, now is the moment if there is interest in that retail bond offering, which, as I said, is underway at this moment. The other thing I will tell you, just in sort of reminiscent terms, is that when I stood here last year, and I actually went and looked this up, if one had left the day after the presentation that I made last year and bought the stock from that moment to today is up 118%. I, again, offer no forecast whatsoever, but instead turn you to this page on the slide, which in one page captures the current financial performance of this business. What you see here, and what I'm going to tell you in terms of what we actually do, is we invest with some of the largest law firms and some of the largest companies in the world in pools and portfolios of their litigation assets. And yes, even though you normally think of litigation as something that you watch on a courtroom television, litigation is just at bottom an attempt to get money to transfer from one company to another. And it is no different than any other garden variety receivable that you see on a balance sheet, and it is capable of all of the other financial treatments that associate those assets, including being lent against and securitized and hypothecated and so on. And so what we are doing is providing corporate finance to people with large litigation claims. And the reason I started off by talking about that is because what I'm going to tell you tonight about litigation and law is all stuff that you already know. And one of those fundamental things is that if I sue you tonight, we're not going to be in court tomorrow. We're going to be in court quite some distance from now. And the reason that's relevant to these numbers is because litigation is fundamentally a medium duration asset. It takes a while to mature. And so what you see in this 6-year-old business, which has gone from a standing start in late 2009 to a market cap today of more than $800 million, is you see the maturity of the development of that portfolio of business. So as we came into being and started both finding and making investments, those investments took some time to mature just as the portfolio grew. And so while our IPO holders, many of whom, by the way, remain in the company today, so the key IPO holders in this business were Invesco and Neil Woodford and Fidelity and Aberdeen, people like that, what you have seen now is us run through the cycle of developing that portfolio and allowing those investment assets to mature, which has produced these results that you're seeing here. 5 years of consistent income and operating profit growth, but almost more exciting than that is that box on the right, cash receipts. So last year alone, we took in more than $140 million of cash receipts from our investment portfolio. And that, parenthetically, if you have bond interest, is more than enough to pay off the entire first bond that we did in a single year. We have also had 5 years of consistent dividend growth, culminating this year in an 8-cent per share dividend. which translates, when you add in the impact of our income growth, into a 16% return on book equity and a 20% return on cash equity in the business. So what is this business all about, and why does it even exist in the first place? All of you probably know something about law and lawyers. Maybe some of you are lawyers. And if you go back not all that far in time, the vast, vast majority of legal services in this world were delivered on a pay-by-the-hour basis. And that's true whether it was writing your will or conducting multi-million-dollar litigation. Lawyers like the model of being paid by the hour. They like getting their cash in quickly. It's quite a simple business, cash partnerships, where income comes in the top, you pay salaries and rent, and the partners divide up what's left. What's missing in that equation, and all of you are here because obviously you're interested in investment strategies, none of you see on any regular basis as investors any law business. And the reason for that is that law firms, by and large, do not access the capital markets. And in fact, in the US, which is our largest single market, although we're very active here in London as well, law firms are not allowed to access the capital markets for equity purposes. And even where they are allowed, like in England, you don't see very much activity at all. Law firms fundamentally are not running balance sheets. They're just these bags of cash. And they're quite large and profitable bags of cash. If English law firms were public, 5 of the FTSE 100 would be law firms. Law firms run in general at about a 40% profit margin, $800 billion of global revenue, but no access to the capital markets. And so what has happened, and you've all witnessed it in the last decade or so, is that corporate clients have become increasingly unwilling to pay ever higher fees by the hour, just at a moment where litigation has become ever more common, ever more expensive, ever more pervasive. Just think, 10 or 15 years ago, if I had told you that Goldman Sachs, HSBC, JP Morgan's earnings, the principal driver of those earnings from quarter-to-quarter volatility was going to be litigation results, you would have thought that that was daft. But that's exactly what is happening in those businesses today. And that has given rise to enormous pressure from those clients onto these law firms to say, no, we're not going to pay you cash fees by the hour any longer. We want you to engage in other kinds of financing transactions. The law firms, for their part, are saying, gosh, we don't have the ability to do that. We don't access the capital markets. We don't run a balance sheet. And so we're going to do what lots of manufacturers do when people want leases instead of purchases. We're going to turn to an outside capital provider to fill that gap, to provide that outsourced capital. And that's exactly what Burford is. Burford is the largest provider in the world of outsourced litigation finance capital to law firms. And the other reason that you see corporate clients doing this is not just that they don't like paying their legal fees anymore, it's that legal fees are a disaster as a corporate accounting matter. When you engage in litigation, you are paying the fees on a current basis through the P&L. Legal fees reduce profits. We do not create an asset out of the pending litigation claim on the balance sheet. It's invisible to you as investors. And worse yet, we'll probably take the position that a big win is not an operating part of the business and it's going to get tucked below the line. So especially if you're an EBITDA trading business, and I used to be, by the way, the global general counsel of Time Warner, the media group, when I did successful, cash-generative, profitable litigation for Time Warner, the market and accounting impact of doing that was to permanently reduce the business's EBITDA. And that's not a good result for businesses. So what is happening is an ever-increasing demand for businesses to move some of this ever-growing expense off their balance sheets and take advantage of outside capital in just the same way that they do for airplanes and real estate and all the other consumables that businesses buy. And this proposition has grown to the point where the very largest companies in the world are doing this. We announced not very long ago a landmark $45 million portfolio financing arrangement with a FTSE 20 company, for example. We don't reveal who our clients are, but if you go and Google that transaction, you'll find lots of speculation in the press that that was British Telecom. So a company like that, whoever the company actually was, but a company like that or any other FTSE 20 company, now to come along and say, gee, the impact of having litigation cost on our P&L is so profound for us that we need, in fairly large dollar volumes, to be engaging in outsourced financing. That's what's driving this business, and it's driving it very significantly, back to the idea of $140 million cash received just last year alone. The stock is up sharply, as we've already discussed, and I'm not going to belabor that point, but more significantly, the fundamentals of the business are also up. So we have operating profit that has been consistently high, income through $100 million for the first time this year, a 75% operating margin in the business, which again, as I said at the outset, led to an increase in the dividend. What's driving all of this is our investment portfolio. The vast majority of the income in this business is coming out of these investments that we make with the world's largest law firms and their corporate clients. And now, this has now been going on for long enough that this is a track record. This isn't just a couple of happy accidents. We've seen 42 separate investments conclude. They've generated $350 million in recoveries and significant portfolio returns, a 28% IRR, a 70% on return on invested capital. And while those numbers do seem high, at the same time, when you add in the relatively high expenses of running a lawyer-run business, these are private equity returns. These aren't out of line with the alternative asset class world. And they're coming in an industry, the legal industry, that is delivering, even on riskless assets, quite high margins, back to the 41% margins in law firms. So these are not returns that are out of step with the industry in which we're operating. The other thing that's nice about this is that by being this large, we can do quite a bit of portfolio construction, and that has enabled us to keep the average duration of the investments right around 2 years. So even though some individual litigation claims, and you've all seen this, drag on and on and on forever, the reality of most litigation claims is that they settle. And again, you all know this just from reading the press. You see an awful lot more press releases announcing the beginning of a piece of litigation than you do seeing CEOs testifying at trial. And this, by the way, is a slight detour back to the bonds. The credit instruments associated with this business, when you think through the impact on the balance sheet of settlements, so if we're investing in a wide portfolio of litigation, and most of those cases are settling, settlements are themselves by definition a cash generative event. Nobody settles for zero. And so when you have that volume of settlements and some wins, even though you will inevitably have losses in this business because the best lawyers in the world lose some cases, it would be very difficult to have the impact of those losses overcome the value of the settlements and the wins. And that's just, again, sort of common sense when you think about the outcome of litigation. And so the result of that from a credit perspective, from a bondholder perspective, is why, even at an earlier stage of this business, people were quite happy to buy these bonds, because the risk of us doing such a bad job in choosing these investments is low enough that the odds of not being able to repay the principal are quite moderate. This chart, which is too small for you to see on this screen probably, but which you can see on our website, in our annual report, and in the slides that will be mailed to you, is how transparent we are with investors. This shows every single investment that has concluded in the business individually. It shows what happens in terms of the dollars in and the dollars recovered, and it shows you on an investment by investment basis what the IRR and what the ROIC was. And we do that because we're not able to talk much about the investments in ongoing litigation, but we want you to have a clear view about what's happening in the portfolio once it's done. And what you see here, and the red at the bottom sums up to those numbers that I was giving you, $350 million of recoveries with those returns. But what you see here is that wide dispersion of results. You see lots of results in the middle, which are mostly those settlements. You see some blowout successes. Those are the cases that go all the way to trial and win. And then you see the inevitable losses, and all of the numbers that we're giving you are net of those inevitable losses. Losing some number of cases in this business is absolutely part of the business model, and the capital is priced to overcome those losses. So that, in a nutshell, is the litigation finance business. It's growing quite rapidly. It has global reach. This is the portfolio that we have today, and this maybe in some ways is the most exciting slide in the presentation, because while all of those financial results were nice, those are history. Those are the results of the investment decisions that have already been made years ago and that have matured. This is the future. This is new commitments to new investment matters, and in 2015 alone, we did more than $200 million of those new commitments. That's more than we've ever done before, and that fuels the growth of the future. The portfolio today stands at more than $627 million of investments. That's across more than 500 individual litigation claims. It is widely diversified by type, by location, by client. You see a trend in this business towards ever larger and more complex transactions as the client base continues to embrace this solution for this pernicious problem that they've had. How to manage the P&L impact and the cash impact of bringing this ever more expensive litigation. And this, by the way, is a problem not only for operating companies, it's also a problem for all sorts of classes of other people in the world. Let's take fund managers, a category that you're all familiar with. What happens if a fund manager or a mutual fund operator invests in a stock that turns out to be a fraud? What do you expect as an investor? Well, you expect them to go and sue on that fraud and attempt to recover for you. But how are they going to do that? Are they going to take capital that you've given them in the mutual fund and instead of investing it in another equity, go and pay millions of pounds to Freshfields to litigate? Well, that seems like not a very happy result. Are they going to take their cherished management fees and spend them on Freshfields fees? I think not. And even if they did and won a big judgment, what do they do with it then? Do they get to put it in their pocket and keep it? Or do they have to pass it on to you? So neither of those are very satisfactory results. So there are lots of constituents in the market that have the need to litigate and a need for capital solutions with which to do it. And that's why the business geographically keeps on spreading. The red on this world map is everywhere that we have a client. We don't litigate in those places. Let's be clear about that. We don't even litigate in France. So we would not do one French company against another French company in a French court. What we certainly would do is a French company coming here to London and litigating in the English courts. And as you know, the English courts open themselves to all comers around the world. So we have clients from around the world, and almost more exciting is the gray on this map. Because the gray on this map are places in the world that we have had people want capital from us, even though we haven't done their deal. And the spread of this concept in a relatively short period of time as law has disintermediated away from the billable hours model is stark. And that suggests future opportunity in this business. This is worth only 30 seconds of your time, and I will try and stop a minute early to take questions. We own and operate in the UK an insurance business which you should treat entirely as a cash bonus. We bought this business for the purpose of taking it, transforming it into our UK litigation finance operation. We have done that successfully. Along the way, we wrote a whole bunch of new business in this operation before a series of regulatory changes that we knew about occurred. And we're now reaping the cash benefits of it. So for an $18.75 million acquisition price, we've driven $74 million of income, $54 million of profit out of this business in the last 3 years. And there's still millions of dollars more in cash income to come, but you should treat this as non-strategic, as a cash bonus that is in soft runoff. And the other thing that we do with regularity is we try out new things that our clients ask. I'm not going to spend any time on these. You can read about them. None of them are financially material, but they show the potential for incremental growth in this business. The balance sheet is strong and simple. We have one single class of public equity. We have today one single class of bonds, and we're about to, next week, close a bond offering that will add a second identical bond, exactly the same term, structure, and conditions, only a new maturity and a coupon. And with that, there are some smiling faces of the 60 people who work in Burford between London and the US, about evenly split between those two locations. And these are people drawn from some of the world's largest law firms and companies who come to Burford and help us choose these investments, diligence them, and keep on hopefully putting up those returns. And with that, some questions.
Thank you. Gentleman there, then one at the back afterwards.
I was going to ask you,
ask you a question about what constraints you saw. We saw some of those graphs where they were going one way, and your answer was the availability of top quality lawyers that Burford take in. It looks like that hasn't been a problem. Do you have another issue that you think might stop that trajectory?
Well, so first of all, the single largest risk in this business, which I probably said last year as well, is making crummy investment decisions that cause us not to do so well. Happily, as the business grows and as we continue to diversify, the risk of that continues to fall. But let us make no mistake about the fact that this business always has the potential for some period-to-period volatility, because we clearly could have an accounting period where we don't have a big win that period and we do have a loss. And even though I have quite a lot of confidence in the overall quality of the portfolio, litigation is litigation, and it's difficult to predict it period by period. So that's sort of issue number one. The people issue is Burford does have some degree of operating leverage, but these are complex, high value pieces of litigation. They require people to diligence them. We actually close a fairly small percentage of the things that come in the door to us, and they require people to manage them. And so as the business grows, we continue to grow the team. We have historically elected not to grow at the expense of profits. Again, back to the medium duration nature of this business. If I go and add a whole bunch of people in a new market today, I'm not going to see income from that new market for a few years. And so I'm subsidizing losses in the interim. And we have elected not to do that with any great vigor, and instead grow the team consistent with the overall growth of the business. And that continues to be the case.
Gentleman at the very back.
There's another listed player in this space called Juridica, and I just would be helpful if you could contrast the business models. I mean, the things that come to mind are that the Juridica, I believe, have a management company built into the structure. I think they value the cases as they go along, and they might have a narrower spread of cases. And I think the CEO has an expensive taste in wives or ex-wives.
That's true. Very quickly about Juridica. So Juridica, you're quite right. Juridica has an entirely different model, but let's sort of deal with Juridica easily, because Juridica is in runoff. So what Juridica did is it raised one single fund. It invested, it follows in a complete private equity model. So Fund 1 was a public AIM-listed fund. It took all the capital that it raised, it invested all of that capital into single litigation cases, and it has ever since been waiting for those returns to come. Juridica has had a fair bit of shareholder noise about it, because I don't know that Juridica's shareholder communication was quite as clear as it may have been, and as you say, there were a variety of collateral issues that took their toll on Juridica. But at the end of the day, Juridica has produced on that pool of cases positive returns, including another $50-something million just this week. But make no mistake, Juridica is in runoff, and that Fund 1, just like a classic private equity fund, will close when it has finished monetizing all of its investments. Juridica has already, quite a while ago, raised Fund 2, which is a private fund, not open for public investment, institutional capital run by that same manager. And so Juridica has quite some time ago signaled its intention to leave the public markets and just be a private vehicle. Burford, on the other hand, is not a fund. Burford is a classic operating business, publicly listed here, single, as I said, single class of equity, single class of debt. The management team of Burford owns about 14% of the equity, 14% of the equity. But other than that, it is a perpetual operating vehicle, just the same way that you would see a commercial finance company generally operate. And we're trying to obviously generate profits here, and we tend to trade more on a PE or earnings basis.
Next question. Gentleman down here.
I'm just interested how you business model, how you manage the business model, because the map that you showed had a lot of red in a lot of areas that you would not consider that the strength of the legal system is, shall we say, particularly reliable.
No, absolutely.
Do you do that by forcing the litigation to countries that have a strong system? Yes. How do you handle it?
Yes, and let's be very clear again about that map. We are not litigating in most of those places. We are taking clients from those places who engage in their litigation in the US courts, in the English courts, in international arbitration before bodies like the ICC and in some other common law courts. But we are not present in domestic litigation in the courts of countries where we don't have the language and legal skills, except for collateral matters. You know, we might have to chase an asset in some other country. But you saw countries up there, Russia, for example. We are absolutely not present in the Russian courts.
Gentleman down here. Just wait for the mic for a second.
I'm not clear what the rationale is for the bond. Is it to service the core business, or is it
Yes.
a separate entity?
No.
And is it there, you know, to avoid the lumpiness of the profits? Can you explain that?
The bond is simply a source of incremental capital. So when we founded the business, it was 100% equity. We did 2 equity raises in 2009 and 2010. We've invested all that capital. We haven't raised equity since. And then as the business is today financed by the reinvestment of the cash receipts that we get from investments, and starting in 2014, we made the decision to add some debt to the capital structure as a way of continuing to have access to capital, enhancing the ROE a little bit. But this is a pretty conservative balance sheet. There's a 0.5x, so 2-to-1 maximum debt to assets covenant. So it's simply part of the capital structure of the business.
Clearly, you're a very successful company. Are you seeing new entrants coming into this space?
Yes. Competition, absolutely, and I love it. We encourage it actively, and the reason that we encourage it is because the goal here, from our perspective, is ubiquity. We would like every company CFO, to do with litigation exactly what they do today with real estate and other asset purchases. We want them to run a financial analysis. I actually don't care if the result of that financial analysis is self-pay, because I know that some percentage of the time it won't be. And the only way to drive a ubiquitous market like that, capital markets for law, is to have multiple players. You wouldn't have any functioning capital market with one player. And so we're happy about entry. The reality of entry is that it touches more people as opposed to touching the same people that we touch and trying to undercut on price. And we're helped by a couple of other competitive factors. One is that law is not the world's most price competitive industry to begin with. You know, the last time you went and hired a lawyer, it was probably not about whether it was 87 or 88 pounds an hour. Wish that either of those numbers were accurate any longer. But the other reason is slightly more technical. To do our diligence, which is substantial, we have to get underneath the legal privilege umbrella, and we have to be able to engage with the lawyer who is trying the case about what the legal theories are, what their strengths are, what the weaknesses are. We are able to do that, but you have to do that in a limited way. And so what that means is that you cannot, if you're seeking financing for a piece of litigation, you can't write a banker book and send it to 25 people and ask them to participate, because you will then bust through the privilege umbrella. And so to the extent that there is sort of competitive beauty parades in this kind of business, they tend to be like bankers and IPOs. They tend to be right up front as opposed to being price auctions for the deals at the end. Sir.
The last question at the very back.
Might be doing acquisitions.
Is it a business that might do acquisitions? The answer is most of our growth has been organic. You did see us opportunistically acquire that UK insurance business. I never say no to non-organic growth, but the reality is I think that we're a pretty large and visible part of the market. Many of the other players in the market are structured as private funds, and so acquisition of private funds on the upswing is more challenging. So I'm always open to non-organic growth, but it hasn't been a huge feature of this business up to now.
One last question at the very back.
Do you see any political risk from the Guernsey structure?
Political risk from the Guernsey structure. No, I don't, in the following sense. And I don't think that there's no tax risk in the world at large in which we live. We are incorporated in Guernsey, but we operate through US and UK operating companies, both of which are tax-paying. What we do is we follow the path of many, many, many American investment managers, and we also use the UK, US, Irish structure that is in common vogue. Will that structure survive 10 years from now? I don't know the answer to that question. However, I'm pretty sure that the answer is not going to be unique to Burford. I'm pretty sure that the answer will be a multi-trillion-dollar answer in the world, and the impact on us, and frankly on everything that you hold in the market, because even Starbucks uses the same structure that we do, is going to be the same.
Guernsey is not as exotic as Panama, though, is it?
Guernsey is not as exotic as Panama. That is certainly true. So thank you very much for your kind attention.
Thank you, Christopher. Thank you.